Hello, my name's Lexie Head, and this is Todd Mercer, and we're the founders and managing partners of Mercer Wealth Management. Today we want to welcome you to our 2024 Market and Economic Outlook. To get started, I'd like to share some exciting updates regarding our team. We're welcoming two new team members, Emily Nelson, who's a Client Services Associate. She'll be working in our affiliate office out of Lexington, Eris Wealth Management. I also want to take a moment to recognize one of our employees, Rachel Bratcher. Rachel was promoted this past fall as an Associate Wealth Advisor. She's in our Wealth Management Advisor Training Program, and she was also named Assistant Vice President. Later this month, she'll be celebrating her 5th anniversary with the firm. We're so grateful to have Rachel as part of our team, and we can't wait to see what else is in store for her. So let's jump into things. For today's agenda, we're going to be covering our 2023 year-end review. We'll go over our 2023 scorecard. So we're actually going to take a look back at the predictions that we made this time last year, and we're going to grade ourselves on whether we got each prediction right or wrong. Next, we're going to talk about where we are now. What's the current market environment and landscape that we're starting the year off with? And then we'll get into our 2024 predictions for the upcoming year. So let's start with our 2023 review.
So in 2023, we had actually the S&P had a really good year. It was up 26.29%. What's interesting is I always like to look inside the numbers. The majority of that return, north of 90% of it, was essentially from what we call the Magnificent Seven stocks, the 7 huge mega cap tech stocks: Apple, Amazon, Google, Facebook, NVIDIA, Tesla, those 7 stocks. The equally weighted market index was only up 13.7 because the rest of the 493 stocks only returned about 9% or less. And most of the year, the other 493 stocks were down. The NASDAQ 100 essentially finished the year up 54%. What's interesting about that number is the NASDAQ 100 finished at 16,898. It actually started in 2022 just a little bit shy of that, and it was just a little bit shy of that in December of 2021 when the market had hit an all-time high. The Dow actually did hit an all-time high in 2023 and was up 12%, and it eclipsed 37,000 last year. The mid-cap and small-cap indices were both up in the mid-teens. And again, you can see the growth index was up 46 and the value index only finished up 9 last year. International emerging markets both had a good year, up 18 and 10% respectively. And the U.S. aggregate bond index actually eked out a gain just in the last few months of the year. So it didn't have a first time ever 3 years back-to-back losing negative yield. The 10-year Treasury, interestingly enough, finished the year and started the year exactly the same at 3.88%. And the 10-year Treasury the 30-year Treasury did the same. Oil prices sold off just at the end of last year, but had remained elevated most of 2023 above the $80 level. Gold was up about 13% last year. The dollar was down slightly, and the Case-Shiller Home Price Index was up almost 5% last year. Here's a graphical illustration of the 4 major indices. Large cap, the S&P, the Russell 2000, the international markets and the emerging markets, and the Bloomberg Aggregate Bond Index. And you can see we had some significant volatility in the equity markets and also in the fixed income markets last year.
So when we look at what sectors performed well, keep in mind that sectors typically rotate. And so a lot of the sectors that did really well in 2023 were actually some of the worst performing sectors in 2022 and vice versa. So who were the top performers? Information technology, communication services, and consumer discretionary were our sector leaders for 2023. Sectors that performed poorly, that's going to be energy, consumer staples, and utilities. But again, energy was the best performing sector in 2022, so keep in mind that these sectors typically rotate, especially when you have big winners or big losers. So now we're going to go through our 2023 scorecard. Again, we're going to look at each of the predictions that we made and let you know if we got them right or if we got them wrong.
I always like to do this because if you watch financial news networks like CNBC, you always see these people come on and make predictions, but you never see anybody hold them accountable, so we like to hold ourselves accountable. So here are our 2023 predictions.
So our first prediction was that U.S. markets would have minimal returns.
Well, unfortunately, we missed that one big. We had predicted, of course, that we're going to have minimal returns. And after 31 years of doing this, I should know that if everybody's pointing in one direction, you should probably walk the other direction. Most analysts predicted the markets were going to be flat or negative in 2023. We agreed for several reasons. We thought the Fed was going to be increasing rates, and we thought that could cause to lead to a recession in 2023, or a second recession in 2023. That obviously didn't happen for some other reasons we're going to get into, but the U.S. markets actually had a great year last year, and so we missed that one.
Our second prediction was that developed international markets and emerging markets would actually outperform.
Well, we missed that one. We didn't really have a strong case for that one, but we thought that international markets and emerging markets would outperform for various reasons, and so we missed that one as well. They did have great years, again, being up north of 18 and north of 10, respectively.
Todd, 0 out of 2, we're not off to a great start.
No, it gets better, though.
Our third prediction was that energy prices would remain elevated.
Well, we got that one right. Although energy prices, as we saw earlier, did decrease right at the end of the year. For most of the year, they were over the $80 a barrel, and sometimes substantially over the $80 a barrel. So energy prices were elevated for most of 2023.
Our fourth prediction was that short-term interest rates would be higher.
We got that one right. The Fed did increase rates 3 times early in 2023, and then they held those rates through all the way through 2023. So we got that one right.
We said that long-term interest rates would remain range-bound.
We also got that one right, with the 10-year and the 30-year essentially starting and ending at the same place, but in the middle of the year spiking on the 10-year north of 5%, and on the 30-year almost 5% as well.
Our sixth prediction was that the dollar would weaken.
And as we saw earlier with the numbers, we got that one right. The dollar weakened by a little over 2%.
We said that layoffs would accelerate, but unemployment would not be significant due to demographics.
What's interesting is most people may have missed this headline, but 2023 was actually known as the year of the layoffs. 300,000 people were laid off in 2023, which is a substantial percentage of the workforce. But because of demographics, we have a shortage of people working age. Those people were able to be assimilated back into the workforce fairly easily. So unemployment still remained south of 4% in the 3% range.
Our next prediction was that corporate earnings would continue to deteriorate.
We got that one right, especially for the first 2 quarters. Corporate earnings were down. They did rebound in the third quarter. We don't have the numbers for the fourth quarter yet for 2023, but corporate earnings were down overall in 2023.
Our ninth prediction was that a second or more defined recession would occur.
Well, this is the third one we missed. We did not get that more defined recession, and we think we didn't get it for several reasons. One, because the unemployment situation. People, even though we did have a lot of layoffs, unemployment did not become a problem, and the consumer continued to spend. In addition, we had the AI craze, or artificial intelligence craze, which really created a lot of speculation, and even though corporate earnings were declining, those stocks benefited from that. And the third reason, I think, or the fourth reason, I think, is because interest rates were elevated. That helped savers and fixed income investors have a little bit of extra money to spend on the consumer side.
Yeah, and then from there we said that the housing market would not collapse, and I think that plays into it as well.
You're right. Normally when interest rates rise and people become unemployed, the housing market collapses or the housing market falls. We did not see that because of interest rates. Most people have a 5 on the front of their mortgage or less, and so since interest rates went up, people did not sell their existing homes, so the new housing market really had a good year as well.
Our next prediction was that we would have political gridlock.
Well, we got that one right for sure. With divided Congress, and then now that it looks like the Republicans can't get along, nor the Democrats can get along as parties, in addition to not being able to get along with each other. So we definitely had political gridlock last year.
We thought inflation would remain difficult to contain.
We got that right, and even though inflation came down substantially from its high in 2022, that last portion of it became really difficult for the Fed to rein out with rising rates and shrinking the money supply.
And then finally, we thought we would continue to have volatility.
And from the charts earlier, we got that one right. You could see that we had some substantial volatility, both in the fixed income and in all the equity markets. So with that said, on 2023, we got 10 out of 13 of our predictions right, which is a 76.9. I would say if you were going to grade this on the curve, because the most important thing is what are the markets going to do, which we missed that one. And probably whether we were going to have a recession or not would be number 2. We missed that one. So we probably didn't get a 76.9 because we missed those 2 big ones. But still, it's very hard to predict that many topics, economic topics. So 10 out of 13 is a pretty good number. We got most of them right.
So let's move on to where we're at today. So we've talked about 2023. It's a new year. We're excited to go into 2024. So let's talk about the current landscape of things and the environment that we're starting the year off in. So where are we now?
Markets are at an all-time high and or close to an all-time high. Again, as I said earlier, the Dow Jones Industrial Average did eclipse its previous high in late 2021, pushing over 37,000. The S&P 500 came within a whisker of its all-time high, and the NASDAQ was within a few percentage points of its all-time high. They have sold off recently in the first few days of January, but we're still close to those all-time highs.
Inflation is also approaching the Federal Reserve's 2% target. Now, like we said earlier, we're sitting around 3.2%, and like Todd said, it's hard to get it right back down to that 2%, but we've made a lot of progress from the highs in July of 2022.
The Federal Reserve, we talked about this in the past. When is the market going to go up? When's the market going to go down? When's it going to return? The Federal Reserve has said they're bringing the punch bowl back to the party, a line that I always like to use. And so the Federal Reserve announced that they held rates after increasing rates in 2023. They held rates to the back half of 2023, and they're discussing now at least 3 rate cuts in 2024.
We think that long-term rates have come down from the 2023 peaks.
Energy prices are stable. In 2022 and 2023, we had a lot of instability in the energy markets because of the war in Ukraine and the embargo against Russia. And whenever there's a big demand or supply side shock in the oil markets, that causes price instability. And so now that those things have kind of worked out, where Russia is selling all their oil to India and China, and OPEC is selling, and the U.S. are selling oil to the U.S. and to Europe, we've got that price stability back in place. So we think we have stable energy prices for the next few years.
The U.S. is still at full employment.
We're definitely in political gridlock with a divided House and Senate.
The housing market continues to remain stable, and the new housing market is booming.
Consumer spending is still strong. We had a record consumer spend for the holiday season, and consumer spending is eclipsing post-COVID numbers substantially.
So, we think a soft landing was accomplished. We don't think we're going to have a recession on the horizon. That goes back to strong consumer spending, strong government spending, and you're going to see that reflected in corporate profits.
Okay. So now to dig into some charts again to illustrate what we just talked about from the past and I think where we're going in the future. So this chart shows the Dow, the S&P, and the NASDAQ, which is the 3 major indices that most people follow. The purple is the NASDAQ, the blue is the S&P, and the turquoise color is the Dow Jones Industrial Average. And what you can see there is all 3 of those averages are either at or have eclipsed their 2021 late 2021 highs again. So we feel like that's going to continue because of corporate earnings and because of a stable economy going forward into 2024. The next slide is what Lexie was talking about earlier, the inflation rate. It came down substantially off the 9.1 in the summer of 2022, and you can see how it's been really difficult to wring out that last portion of inflation where the inflation rate has hovered over that 3% level for the back half of 2023. We think that with what the Fed's doing with interest rates still being high and shrinking M2 by letting bonds roll off the balance sheet, we think we'll probably get that last portion wrung out sometime this year and allow for rate cuts. This is what happens to the market again once the Fed does cut rates, you can see here going back to 1995, when the Fed cuts rates, which is the orange line, the Fed fund rate, every time following that you can see where there's a market rally that holds after the Fed cuts rates. And so we think that's going to continue this time. Here's the long bond, or the 10-year Treasury. And you can see it remains elevated from where it was over the past 5-6 years. But you can see where it came down at the end of last year. And we think that that's going to probably continue to happen over 2024. It'll spike maybe back up again, but keep in that range between the 5 and the 3% range. As we talked about earlier, because of the supply and demand shocks have stabilized and the U.S. is producing oil again, we feel like that the oil markets are going to remain constant in that $60 to $90 maybe a barrel range for oil prices, which really helps the economy when you have stable energy prices. Going back to the unemployment rate, this illustrates what we were talking about with the unemployment rate. You can see this is the U6, U5, and U3 numbers. U3 is the headline number, which everybody looks at, and we're north, or south rather, of 4% unemployment right now, and we think that may go up a little bit this year, but we think still unemployment we're going to remain at full employment for the U.S. economy. This is an important part of that. We are still below pre-COVID levels on the labor participation rate, meaning how many people of the working age are participating in the labor force. And you can see going back to 2011, it was at 64.2%, and then post-COVID, it had gotten all the way back up to 63.4%, and now we're still only at 62.8%. So those are millions of people that were in the labor force before COVID that are not returning to the labor force for various reasons. And we really need those people to come back to the labor force because we're at a shortage of workers in the United States. This illustrates a political gridlock. Last year, there were 700 votes in the House on legislation, and only 27 bills made it into law, thanks to the tiny majorities and the divided government between the right and the left. If you've heard us talk in the past, we've talked about it really doesn't matter who the president is when it comes to market returns. And what this slide and the next slide illustrate is essentially there have been 24 election cycles since the S&P was created back in 1928. And of that, 83% of the time have had positive performance. When a Republican's elected, going back to 1928, the market's average of 15.3% rate of return in election years. When a Democrat's elected, it's 8.5%. On average, it's been 11.5%. So I'm not advocating a Republican or Democrat get elected. I'm just saying that it really doesn't matter, and in most election years, you have a positive rate of return in the market. And this slide illustrates every election year, going back to Biden all the way back to Hoover, and you can see there's only 4 years where the market returned negatively in election year, and most of the years that were positive, they were well into the double digits. We talked a little bit about consumer spending. You can see consumer spending is at an all-time high right now, and again, that's the number one portion, 70% of GDP, and so we really think consumer spending is going to continue to be strong going into 2024. This is government spending. That's the other biggest portion of GDP, and you can see government spending is at an all-time high. Part of that because of the Inflation Reduction Act. Part of that is because of the transportation bill. So there's a lot of fiscal spending still going into the market, which is going to be good for corporate earnings. And then this illustrates, we talked about earlier, corporate profits are returning. You can see in the first half of 2023, corporate profits were down from 2022, but you can see they rebounded in the third quarter, and we think they rebounded again in the fourth quarter, and that's going to continue into 2024.
Okay, so we've talked about, we've looked back, we've looked at where we were in 2023, we've talked about where we're at the start of 2024. Let's get into our predictions and our positioning for the upcoming year.
So first, we think for various reasons, one, the Fed's going to decrease rates. Two, it's an election year, and for various reasons, we usually have a good return in the election year. We think we're going to have a really good year in the market next year. We don't know it's going to be a 20% year, but we think the markets are going to return at least north of 10% and return to all-time new highs.
We think that markets will broaden out past the Magnificent Seven. So you'll see those other 493 stocks, or a good portion of them, start to perform well also.
Developed international markets are also going to have a good year. We don't know that they will outperform the U.S. markets, but we think the U.S. or the developed markets and the emerging markets are going to have a good year.
We think energy prices are going to remain in that $60 to $90 a barrel range.
Short-term interest rates will fall, again, because the Fed has announced that they're going to decrease rates on the short term for at least three times next year.
We think that the long-term interest rates will continue to be range-bound again.
I think the dollar is going to continue to weaken.
Unemployment may rise slightly, but it's not going to be significant, again, due to the demographic issues that we have in this country.
We think that corporate earnings are going to continue to rise.
We don't think we'll have a recession this year.
The housing market will not collapse and remain strong.
We'll continue to have political gridlock with a split Congress and it being an election year.
Inflation continues to decline down to that 2% target rate, which will allow the Fed to decrease rates.
And finally, we'll continue to have volatility. We don't think it's a straight shot up from here. You're going to see some bumps along the way.
What I would like to say is with our positioning, we're getting back to normal. After COVID and after the spike in inflation and some of the other things we've had with oil shocks, with the Ukraine-Israeli wars, we're getting back to a more normal positioning. We think 2024 could be, right now, the way it's looking, unless there's some kind of major shock, it's going to be a vanilla ice cream kind of year. So we're moving back to and we already have been doing this, to a 40 to 90% diversified equities portfolio. And when we say diversified equities, we mean growth, value on the large cap side, small cap, mid cap, international, and emerging markets. So we're really moving back to that diversified equity portfolio, and we started moving to that portfolio about the middle of last year. We also believe that clients that can have the risk tolerance and have the liquidity available to do anywhere between 0 to 30% in alternative investments. We think that can add a lot of diversification and excess return to client portfolios. And then finally, 10 to 40% in short-term and intermediate term fixed securities, and that would be money markets, and then 7 years or less on the intermediate term fixed securities. And of course, these ranges depend on your goals and your asset allocation needs based off your risk tolerance. Finally, what I'd like to leave you with is something from my business partner, who is the planner here. The last 20 years has been really hard with the capital markets returns that we've had, meaning that the capital markets are returning to longer term averages. And what I mean by that is cash, fixed income, and equities have not returned what they normally have returned historically. The cash and fixed income cash has been zero and fixed income has been almost zero in returns. And so when you do financial planning, most of the time cash has a return of about 3 to 3.5%, and fixed income has a return north of 5%. And as you can see from what happened at the end of 2023 and what we think is going to happen in 2024, those numbers on cash and fixed income are going to be closer to the historical averages. So we think this is going to be more stabilizing to the markets and not destabilizing the markets. I'd like to remind everybody that in 1999, the last part of the tech bubble, we had the prime rate was at 9.5%, and mortgage rates were at 8%, and the market returned 29%. So the thought process of you can't get big returns in the market, or you can't get historical returns in the market when interest rates are up, is not a true statement. So the capital markets returning to long-term averages we think is good for the overall economy and also for financial planning as a whole.
So we want to thank you for joining us today. We appreciate your time, and we appreciate working with each and every one of you. If you found this video helpful, please let us know. We look forward to meeting with you in the coming weeks and months. And again, thank you for being with us.